Hi, today on InMIF.com online educational program. This is the second episode of our series on understanding sales pitches by financial sales practitioners and on the pitfalls of taking them at face value. Now, one of the most commonly purchased insurance product in Singapore is investment-linked insurance plan, commonly known as ILP. Now, let's start with the 10 most commonly heard sales pitches to get you to purchase on these ILPs. Number 1, buy term, invest the rest. Not only that, you get coverage as well. Where else can you get such a good deal, right? Number 2, the good old sales pitch, forced savings. Next up are lifestyle choices. You can stop paying premium when you need to. For example, you stop work for a year or two. Anytime you need the money, this is one very liquid insurance plan that you can withdraw money from. Furthermore, when you need more coverage, you can simply increase it. When you need less, you can do that as well. And then comes the most exciting element of investment into the picture. The HO term dollar cost averaging comes in to help you manage your risk. Anytime you want to convert it into a retirement plan, you can do that. When you want less risk in your investment portfolio, you can change asset allocation anytime to reduce risk accordingly. Lastly, you enjoy critical illness coverage on top of the basic death and disability coverage. For now, don't you think there is no reason for anyone not to get such a plan for themselves? After all these pitches have been made in your face, let's cool down and understand how many of those 10 sales pitches actually are valid. There are 4 important features of an ILP that will decide how and when and for whom an ILP makes sense for a policy holder. Number 1 is the unit allocation, which will be covered for today's episode. Now, the next 3 components, which is cost of insurance, policy charges, investment-related charges, will be covered in the following episodes. At the same time, we will study in later episodes the wisdom and sometimes the lack of it for salesperson who actually sell ILPs using the following pitches as covered a few slides before. Now let's take a look at this. This is a table of how your premiums are allocated as investment units of a typical ILP. Do you realize that in the first 3 years, 179% of annual premium are being deducted? Most people don't realize this, but the big but here is they only remember the salesperson emphasizing this. You can actually enjoy 5% more than what you put in from the 10th year onwards. Let's do some simple mathematics here. 179% of units being eaten away takes about 36 years of extra 5% units to recoup. Remember the extra 5% that takes place only on the 10th year onwards? You take 46 years to recoup. Now, how many 46 years do we have? Furthermore, the allocated units you see are not the net amount invested. All other charges, which will be covered in the next episode, will be deducted then by selling these units. So now that we know one small feature of ILP or unit allocation, how does the following sales pitches make sense? Number 1, is it even a savings in the first place? Or at the rate of the investment value grows, when can it start being liquid? Looking at this point, I just like to ask, when do we see gains? The next 3 points do not make sense also, saying that it is not even an investment plan in the first place. In our next video, we will cover the structure of the cost of insurance in ILP and its charges. And then we will review how all this stack up to make sense of ILP in your portfolio.